Well, as I mentioned, the Bank of Canada is holding its benchmark interest rate steady at 5%. It was the third consecutive time it decided to do that. And within the Bank of Canada's statement, it highlighted today that higher interest rates are clearly restraining spending when it comes to consumers. The labor market continues to ease, and the economy is no longer in excess demand, it said. For more on what we heard today from the Bank of Canada, we're joined by Francis Fong, Managing Director at TD Economics. Francis, thanks so much for coming in.
Thanks for having me back, Jacqueline.
So what do you make of the tone of the Bank of Canada's statement today? Because it did take out that part of the statement that talked about risks to inflation increasing, which we saw come up in the last one. But, still talked about the willingness to raise interest rates further. There was a little bit in this hand, a little bit in column A and a little bit in column B.
Yeah, absolutely. I think a lot of that statement you had just quoted about was really for the benefit of bond markets. So we don't see as much loosening in bond markets, as we saw. And we did see bonds rally on the longer end of the curve in response to some of these remarks. And really, it's a function of where the data has come in over the past couple of weeks. Like, we've seen growth slow quite a lot. The inflation numbers have moved in the right direction. Underlying inflationary pressures still ever present, which is why I think the hawkish tone had to stay there, because really we're still seeing some heat in some of those core components like services, in wage growth and things like that. So not a lot of surprises here, but certainly I think a much needed reprieve for markets and the economy.
Do you think that the Bank of Canada might have needed to be more hawkish, though, if it's still got this? I mean, if core is still around 3.5%, it's still got a ways to go, and markets are pricing in cuts in the spring, and you are seeing, yields coming down. So with all of that, should the bank be projecting more of a hawkish tone if they want to, keep markets from getting ahead of themselves?
Yeah, that's a great question. And quite frankly, to that exact point, if you're going to look at the balance of risks, they're still skewed slightly to the upside. If you look at wage growth, still 5% year over year. Underlying services inflation still quite hot. It's really what we're talking about in terms of our growth numbers are coming in quite a lot, more so than the U.S. And the headline inflation numbers are all being driven by things like falling gasoline prices, all of which could turn on their head heading into the winter with this El Nino cycle that's causing all sorts of problems in different commodity markets, whether that's sugar prices or coffee prices, things like that. And then we have the geopolitical risks leading to potential upside for oil prices. So if we're looking still at that balance of risks, it's still slightly skewed to the upside. So a hawkish tone definitely called for. Should they have gone a little bit further than they did today? That's debatable, because those growth numbers are really, really weak. Like, note that we really just skirted a technical recession with the GDP numbers that came out the other day. We got a second quarter of negative growth, but we only avoided it because the previous quarter was upgraded. So heading into the coming few months, we're looking at some very weak growth, and I think rightly so. The bank has to be worried about the impact that more mortgages renewing into these higher interest rates, the impact on debt service costs, and the outlook for consumer spending.
Would the Bank of Canada, though, also be worried about those yields coming down? We're also seeing mortgage rates come down a little bit as well. I was checking in with ratehub.ca today. We've got a graph that just shows a tiny tick down in the 5-year fixed mortgage rate. So instead of about 5.25%, it's about 5.19. There, you can just barely see it on the white line there. Does it, risk stoking the housing market again? As we saw last spring with the first hold, of course, we know that the Bank of Canada picked up again after that. But with this expectation that markets have for these cuts to be coming in the spring, how do you see that playing out when it comes to housing?
That's a great point. You know what? I will note that exactly what you just described, it happens every cycle. When we look at these inflection points, things just start to turn, and even that tiny little turn stokes a tremendous amount of demand, because there's been so much that have been pent up. You have delayed household formation because, hey, prices are a little bit too high, rates are a little too aggressive, can't really get in right now, but hey, things are changing. It's coming into a little bit of a buyer's market because there's the sellers are trying to price a little bit lower to attract buyers. maybe this is a good time. And then all of a sudden you have all of this demand that's been waiting in the wings. That's a very housing market specific story, but as we know in this country, real estate is a huge driver of that demand, because it's not just the housing itself, it's the renovation spending, it's the household equipment spending, all of that comes with it. So I do think that the Bank of Canada does have to keep their finger on the button for potentially higher rates. But our baseline is technically that the growth profile does lead to some cuts down later in the spring. But then I will point to the upside risks potentially leading to higher rates for longer.
I wanted to get your thoughts, too, on the productivity problem that Canada is facing right now, because we did get more productivity data, or new productivity data from Statistics Canada today, and it showed it is the 6th consecutive quarterly decline for productivity in this country. And when you're thinking about that in combination with trying to get inflation down and just the whole sort of economic scenario that we're in right now, how much of a priority do you think that addressing the productivity, decline in this country should be?
Yeah, that's a tough nut to crack. I will also note that it's not just that the Canadian numbers are bad, but they're so much worse than our U.S. counterparts, where productivity growth was fantastic in the previous quarter. So it is this perennial question that we have in Canada about low productivity growth. We have tended not to focus on the Bank of Canada as a solution for that, simply because the tools they have are very blunt. Like, you have one interest rate that applies to the entire economy. The ability to influence investment spending or innovation spending, it's one of many tools that we could potentially use. But certainly it is one factor. The user cost of capital is determined by interest rates overall. And having rates as high as they are, in a country that has such a high cost of living like Canada, it does make it difficult for businesses to invest in, which I often will say it is the one area that is often not discussed. Like, we talk about household debt so often, about over-indebted households, the impact on consumer spending. Businesses, corporates are just as indebted in Canada, and they've built up just as much corporate debt over the many years that we've been talking about household debt, and high rates are notionally pinching even more there.